Kristen, are you there? Tim?
I'm here.
Hi, Kristen.
Hey,
Tim?
I don't see him on the screen here.
Okay.
So he hasn't joined. I know Jim's going to be joining about 5 minutes late in person.
You've got your California look working.
I know, right? It's hot here.
Welcome to the September meeting of the Greater Boise Auditorium District. I'm Jody Olson, the vice chairman, acting as chairman today. Our chair, Kristen Muckall, is out of state. However, she is here on Zoom. Roll call, please.
Ms. Muckout,
Here.
Mr. Olson,
Here.
Mr. Walker, Mr. Erkins,
Here.
Mr. Rastegar. Mr. Rastegar?
He's muted.
He's muted.
He's on.
So he's on. If you can unmute yourself, TM, so we can get you on roll call.
Here we go. Sorry about that. I'm here.
Thank you.
Kristen, do you have any opening remarks?
No. Cody? Yeah, I've got some changes that I'd recommend to the board for the additions or changes to the agenda. Moving item D on the agenda after other business A, that'll allow Clearwater to get their report in, and then we can go into exec session, so that won't force them to have to wait after that. I'll make that recommendation.
So moved.
Second.
All those in favor say aye.
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 Any opposed? Okay, now, Kristen, you're on.
I think you might have all seen the article that came out in the Idaho Statesman. And I wanted to thank Cody and Mary Michael for adding some content to that, and then just kind of a thought process about, moving forward with requests from media. Typically, I think in the past, Cody and Mary Michael, or Pat, the executive director, and Mary Michael have kind of handled those, so that we kind of funnel all questions and stuff through there. So I know that's been handled in the past. So if you guys wanted to continue with that practice, because I know that we'll probably get some more inquiries as we keep moving forward, that certainly helps us speak with one voice, but open to discussion on how you guys feel about that.
Okay. Anything else, Kristen?
Nope, that's it.
We're joined by Jim Walker. We're all here in one form or another. We will now go to the minutes. They were distributed to you earlier. Can I get a motion?
Move to approve the minutes.
Thank you, Chase. Thank you, Jim. All those in favor say aye.
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 Any opposed? Okay, monthly activity and financial report. Cody Lund and Stephanie Burnside, our brain trust.
Okay. Thank you, directors of the board, Madam Chair, or Vice Chair currently today. I'm filling in for the chair. Just excited about this opportunity to report our August financials at the September meeting. Make sure I got there we go. As always, just starting out with a few highlights, and I know I won't go too in depth on that one photo in the upper left, because I know Ali and Carrie touched base on meetings today live, but that was held in August. That's suppliers and event planners getting together and kind of opportunity for looking at potential business and matches for that business. Hosting that in Boise really just gave us a chance to host many meeting planners that normally wouldn't have got a chance to come here. It's a big benefit for us once we get them into Boise. So that event had just a great opportunity, and I think the team took full advantage of that opportunity with meetings today. Last month, we hosted, as we do each year, the Albertsons Boise Open. It's a big, large dinner and a concert. So we had Brett Michaels in the ballroom downstairs in the Albertsons Open dinner. So that's kind of what I consider our kickoff to busy season. Once we've got the Albertsons Open, it pretty much is nonstop between that and middle of December when our holiday parties kind of cease. Then up on the top right photo here is the new terrace window clings. You can take a look at it as you leave today, but it's out on our terrace. We just skinned the glass along the back side of that window, put a nice little cityscape of Boise. That was 7 years old after the expansion at this point in time, and those clings were getting very bubbled and dated and looking faded from the sun. So we just replaced those as well. And it looks really good. So nice job by Cliff and kind of getting that design work done for the team.
And Cody, that's a different issue than our other glasses.
Correct. That's just the glass behind that terrace to kind of block out you would see the roof if we didn't have those window clings behind the terrace there. So it's really just to block out.
And where are the ones that we're having an issue?
Over on the east building, they face out towards the plaza, second floor and fourth floor. You'll see bubbles on those glass. We've tinted or covered a couple of the ones on the fourth floor just so that they weren't visually unappealing for the guests. But at this point, the second floor has the majority of the failing glass that's happening. And you can see it over at the east building. Attorneys are still working on that right now as we speak. So we're going down the road of trying to figure out what we can do legally.
That company's still in bankruptcy.
They filed Chapter 21 bankruptcy. It still allows them to operate in the Chapter 21. So they're fulfilling their obligations per contracts, and they're currently operating as normal with the Chapter 21, from my understanding at this point. They have new ownership that's holding to any of their warranty claims. So there is some news where they did some settlements before they had a buyout with new ownership. And so that's changed, I think, their approach to some of the claims at this point in time.
Next month?
Sure, yeah, we can have Jim Martin show up, Mr. Chair.
Yeah, that would be a good idea.
Thank you.
Again, just some operational updates, some miscellaneous ones. We had our all-staff meeting last month on August 26th. We brought in Carol Barks, the keynote speaker, who is a specialist in communication, especially nonverbal communication styles. So for our team, it's a very important thing as we're doing customer service, whether a guest's unhappy with their meal, unhappy with maybe some of the services they've received. So we got really into kind of taking nonverbal cues and getting some education from a very well-renowned nonverbal communication specialist that came as our keynote. Then we did some team building around that as well, and a great opportunity to kind of go through updates with the entire staff. We had close to 200 show up of our 240 staff, so a good number showed up to that. We conducted respectful workplace training last month with HR. So we did that in several different, did 2 different sessions. So that way we made sure everybody within the organization could participate. And then we have recently promoted Amy Hildebrandt to Assistant Operations Manager. We had 2 co-managers in that Department of Operations before. We lost the second manager. We brought them in actually not too long ago. They got another job offer. So what we did is we've gone away from that co-manager and promoted to an assistant manager. So there's an operations manager and an assistant now versus 2 operations managers.
And report to Julie.
Yes, correct. But report to the Director of Operations through Nick Choba, which reports to Julie. So they funnel up to Julie. Total events, we had a pretty slow August, but overall August tends to be a little bit slower. 11 total events. 22 or in 23, we had 22. So again, about half the number of events. We're seeing that compression starting to go away, and I've highlighted this and flagged this to the board for several months. One nice little piece of business that populated up in August, that was a new piece of business, is a Boise Public Library Comic Arts Festival that brought in 5,500 attendees. So our attendance shot up in August from what it historically has been at, because that's an open to the public type trade show. It was very well received, and they want to come back again next year. They had a great event. So we're looking forward to that event being added in August, hopefully as a repeat going forward. And then in IASA, the school administrators meet each year in August and bring in about 880 room nights. So those are some of the highlights. On the event side, front and center, Boise State, we hosted a job fair over at Boise State as all the students are coming back onto campus. And this always gets us a few employees, but it had a really good return this year in particular. We were able to kind of fill in the gaps that we've needed for the fall for getting our staffing up to the levels that it would normally be at. And again, the fall busy season is here, and the team can feel it. I know that as I look in their eyes. It's a lot different from July and August. And what I'm noticing this year, which is probably different than the prior, our past 2 years in July and August have been very busy because of that compression. This year, we went back to kind of a normalcy a little bit, where it slowed down quite a bit. And that ramp up from going from 0 to 60 to the fall has been different. Last year was less of a ramp up because the team didn't really get that slowdown. So in some ways that's a benefit, but in other ways it's also a ramp back up. And I can see that on the faces as they're working longer hours and more events as we get into the fall. On the sales side, Alhi, which is a great hospitality group in particular, had a Boise meeting. We brought them in as part of Boise Meeting Pros on August 22nd. And great information is what I could just say. We had a keynote speaker that shared unbelievable amount of data and information that I think solidified what everybody else has seen. He's been all over the United States. and spoke about kind of the conditions in the market and what we're seeing from trends. Everybody else is seeing that same compression slowdown happen across the United States at this point in time. Depending on their markets, they're either depending on when they open back up or when they close down from COVID. Some of them are pacing a little differently than others, but most of it's all that compression from post-COVID is starting to go away. And in particular, there was some interesting data that's shared, and I think we've heard this at IAVM as well, but Michael Dominguez is the speaker that came and spoke at that. Really highlighted that there's a difference in kind of the attendee group, the age group of attendees showing up to events. So, and we talked about this in our budget meeting, that there is a trend right now where alcohol consumption at events is actually down, that the next generation isn't drinking as much as the prior generation. So those are things that are impacting our forecasting as we look at events going forward. And then Beef Improvement Federation confirmed for June of 2026, and that's a great piece of business with 850 room nights. So the sales team, while we are seeing a little slowdown, is continuing to hit the pavement and get what businesses out there. And as I spoke about, a little slower July, a little slower August, as you can see. So this is the first time these last 2 months have actually been below what we've seen in 22 and 23 for the first 2 months out of this entire fiscal year. Again, I think that's somewhat of an indicator that there is a cooling off, but what you're gonna see, and I believe will happen here, is that September number will shoot up above what we've seen for 22 and 23, because September is very busy. Again, October is very busy and November is very busy. So I anticipate the last quarter it to pace very similarly or above 22 or 23 at this point in time, as you're looking at those other dots on the screen. Currently on pace for our 10.4 budgeted revenues. I think that will hit closer to 10.9 at this point in time. So we're significantly outpacing what was forecasted at this point in time, but still seeing that slowdown happen.
Hey, Cody, can I ask,
Yes.
we talked about the fact that the Festival of Trees was gonna maybe instead be reported in the following year.
Correct.
Did we figure, is that?
It will,
actually
so
the
it will
case?
hit next year. That's a great point. And it's something that we talked about in the budget yesterday or the finance committee meeting. Festival of Trees, based off of when we report or when we financially accrue the event, it's based off the end date. This year, Festival of Trees will end in December. Well, December 1st is our new fiscal year. So Festival of Trees will actually fall twice in one fiscal year. It won't fall in this fiscal year. It'll fall twice next year. So the beginning of this fiscal year will start out December with a very great piece of business, which is Festival of Trees. I've been forecasting about 11 million for this last year. I think at about 10.9 because of that forecast number is going to fall into next year for December at this point. So we'll probably finish at about a 10.9. But Festival will show up in December of 25. Which is actually December of 24, but fiscal year 25, and then in November of 25. So we're going to have a stronger year, just inflated a little bit because Festival hits twice. It's a great piece of business. So great reminder. Continuing to see, again, slower August led to a little dip. We were up to about 17% last month in the gross margin. We're down to 15.2, still just above our goal, but with the fourth quarter ahead of us, I feel confident that we're going to be able to maintain that and hit our goal of 15%. Room revenues. This has been one that is just an interesting thing to watch. And this is something that I've spoke to the board about. The ability to get more hotel contracts or more room blocks has been a challenge. And I think it will continue to be a challenge when you're seeing revenues come in at this rate. In particular, August, as you can see, one of the highest numbers is that orange right here, coming in at 24 million. That's not district revenue. That's total revenue for group one on the STR reports, which is where we get our 5% from. So we get a 5% approximately of that number there. And again, as you take a look at August's in that orange bar is higher than any other prior bar. So the revenues are continuing to increase. And what's interesting about that is you're going to take a look at the next one, which is lodging room demand. The demand is also up the highest it's been. So that August number above 150,000 demand on the rooms. This summer was really good for the hotels. So from a short-term leisure booking side, they're probably hedging their bets more on that short-term ADR than on group rates at this point in time. Now, as things change post-election, I think that might start. And also with the AC element coming on in early 2026, we anticipate that's going to change some of that mix and their flexibility for room blocks going forward. Again, this is some data that you guys have looked at all year long as they've been pacing pretty much right on top of each other. That top line here is your ADR. So that's your average daily rates at the hotels. And the orange one is the 2024 number. So for the first time this year, if you noticed in June, we started seeing a separation and it actually was lower. And since then, it's actually come back up to where it's higher than the two prior months from the months from the prior year. And again, occupancy in August last year, 79.8. This year it's 81.3. ADRs last year, 158.9. Now it up to 162. So the hotels are continuing to see record demand, record occupancies, and record ADRs, which bodes very well for the hotels. It also bodes well for the district on that 5% collection, but it does put a challenge to the number of conventions, and I'll speak about that when we get into our finance committee topic later on the agenda.
Cody, how many rooms are coming on board within the next 6 to 12 months?
I've estimated at this point in time, a little over 3,000. That's small stuff all over. That's not mostly in the downtown core though. That's little stuff out towards Eagle, Top Golf, and some other stuff there. So
Say 3,000
it's
rooms?
total within the Group 1 district is what I'm estimating.
Wow.
We went up about, and I can show you this data, and I'll put it actually in the next month's report. But we went up about 6,000 total rooms this year from last year fiscally, from last August to this August,
Still
6,000,
maintaining an 80% occupancy rate.
even with 6,000 more. So if you take it, actually,
Higher rates.
that's a great point right there. So last year we were at 179,800 rooms in August of last year in the inventory. This month, this August,
Sorry, you're talking total room nights. Sorry, I thought you meant, never mind. I thought you meant how many more hotel rooms there are built.
Additional rooms.
Oh, yeah.
That's what I thought.
That's actually what I was.
That's what I thought, yeah. He was asking how many more hotel.
and I'm anticipating within the district, there'll be about 3,000 total.
Go ahead, Jim.
No, that's what I was,
Right, right,
yeah, that's wasn't just room night, that's just.
We had 6,000 so far year over year from last year. Now, big part of that, we had a couple big hotels pop in the area, but small hotels are continuing to pop up in the district. So it's helping, but that to your point, 6,000 more rooms year over year, and they outpaced the occupancy and they outpaced the ADR with those additional 6,000 rooms. So something to pay attention to. Yes. Again, this is a static slide, so I don't mean to skip over it, but it is something that just allows us to forecast. Not much has changed based off of what I'm seeing, even from those increases in ADRs. We're forecasting for ADR at the end of the year to average out to about $150. That's over the course of the entire year, and an occupancy 68.3. That number might bump up depending on if the fall continues to see the pacing that we're seeing. So both of those numbers could go up as we get the last quarter, depending on how that finishes out. Future book business. This is again, Ali's slide that is the sales team's activities. So that blue box in the front, on the left is the current month future booked economic impact. There's 887,000 booked within this month alone, a future booked, that's any year forward. So that's not just in next year. And then the prior year to date, we're starting to see that pacing start to drop off for the first time. This year, this is the first month I've actually seen that in this report, where the year to date prior was higher than the orange bar, which is the current year to date. So 14.1 million, off quite a bit in the pacing of future business. So we're continuing to get aggressive. Some of that's where we put some incentives for future booked business, and looking at some of the hot dates that we know we can fill and try to incentivize that business. And then on the booked revenue, similar story here, except for they actually are pacing on the revenue side very close or closer to the year to date prior, on that future booked revenue within Boise Center. And then booked future nights of rooms. Currently, they're pacing at 1,500 in the last month alone. Year to date prior, they were at 26,927, and right now they're at 25. So this is the first month that all those orange bars are lower than the purple bar. So we are seeing that indication of the slowdown happening. And attendance, the one I just kind of spoke about. We had a historically high August attendance due to that new public library event. So we're pacing very, very well, but August obviously was a bit of an anomaly with, if we have public shows, that's where you'll see those numbers jump up. In March, it's Flower and Garden Show, making that number drastically go up. And we're on pace for our current goals at this point in time. Economic impact. Last month alone, 3.1, and that was again a little bit of a dog of a month compared to the prior years, but we're more back into what we consider normalizing within August, what we've seen historically prior to the pandemic. And economic impact, we're sitting at 34,009 on pace for our 41,000 or 41 million goal. I think we'll hit closer to 42 is what my estimation is at this time. So the team's done a great job. Now that number started out at 35 million, the goal at the beginning of the year. So just highlighting to the board, we did adjust the formula to capture more spend on the local, and we adjusted that goal up to capture that additional spend. And we're still pacing to hit that goal. Overall guest experience. This is one that I continue just to be proud of the team and what they're doing. We've only had one number 3 all year long on our overall experience at Boise Center. And then everything else continues. And we had only 2 additions in August since the last month I reported. So those 2 actually were 5. So it went from 66 to 68 on that line there. And again, we continue to see a response rate of about 36.5%, which is historical, what we kind of see from responses from events. Some challenges and strategies. I know I talk about this each month, but budgeting for the new normal, as you're starting to see that cooling off, and I'll speak about this on other business item B when we get through the Finance Committee draft budget review, kind of just topic that is on the agenda. But that use of historical data and experience is really what's benefiting us this year and looking at how we can best evaluate our space, what we've got on the books, and what we're going to pick up within the year. Prior to the last year and this year, we historically had, within the time that we were doing budgets, about 50% of the events on the calendar, and then we forecasted about 50% picking up within the year. That makes it very tough to get accurate budgets. This year and the last year, we were closer to 60, and this year we're closer to 70% already on the books, in forecasted, and then we can sit there at the 30% and kind of estimate what events we might pick up within the year. And we're less pie in the sky, a little less guessing that's happening on that. So it's narrowing down, our forecasting is getting closer and closer each year. Lost business and market conditions, that's continuing to be one thing that we're paying attention to. The availability of hotel rooms or the number of rooms that they can get under one contract is probably our biggest. And then the market conditions within what you're seeing in the hotels. So when hotels are seeing the ADRs coming at that rate, with that kind of occupancy, the group rates are further down their list of priorities. That's where the industry research meetings and events, and we're continuing to meet now probably every other month with hotels going forward and starting to do a strategy meeting so we can let them know where we're seeing some of the lost business. A couple other things we've done is we're working with the Visit Boise group on identifying prime leads. We think some of the best leads are getting lost just in the natural flow of other leads coming in. And so we really want to highlight the ones that we think are special and unique, that have an opportunity to really drive economic impact, drive heads and beds. And so we've got a different kind of strategy to how those will be presented to the hotels going forward. And then I'll speak about this too on that Finance Committee draft budget review topic. Insurance benefits and wages continue to be the biggest driver of some of our increased costs. So that's really comes down to how we can be efficient in managing our staff, revenue managing the space. And I think some information that I showed Jody yesterday for the draft budget stuff, we continue to be improving by about $2,000 to $3,000 every year over year on the average income from an event at Boise Center. So going back, I went all the way back to prior to the pandemic, which would have been 2019. We did 337 events for 7.7 million. So you come out to 20,000+ per event. We're up to above 42,000 this year, forecasting for next year per event. So it shows you we've actually more than doubled since 2019, the average spend per event that's on the calendar. So I think we're doing a great job of revenue managing and trying to drive more revenue to the center and the district. Questions?
Comments or questions for Cody? Kristen? Are you there?
Not on my end.
Kim?
None from my end either.
Okay, thank you. Stephanie?
Good afternoon. This is your treasury report, year-to-date revenues for the Boise Center, 6.9 million. Your expenses for Boise Center were 13.164. You have a variance there from the revenues and expenses versus what was budgeted of about $616,000. It looks as if the transfers from the district to the centers received 6.5 as of August 31st. The reason that the 6.382 is in the district column is there's an offset there of about 120,000. It was with an aquatics transaction back in February, and we're still looking at that. So that's why the numbers are different. Otherwise, they should be the same. The tax revenues for August was 1.158. This is up. Yeah, I know. Mike goes, wow.
So this is that August.
This
right?
is August.
That's what you see when August happens the way it did.
Yeah. So year to date, where am I? Year to date, $7,790,000. And this is up from last year at this particular time by 920,000. So. This slide is your transfers, money transferred, that 6.5. This is just for August. What was transferred for capital projects was about $53,000. Your operating is $810,000, and the bond payment was about $140,000.
And I just highlight to the board here as I take a look, so that this looks like Legos being stacked on top of each other. But that top bar there, that's gray on the operating account, and then that bigger blue bar, those two largest sections that you'll see, that's December and August. So when we tend to have slower months at the center, we have to subsidize a little heavier. So that just kind of highlights that that's pretty normal for what we kind of see from year to year, especially prior to the pandemic. Going back into 21, you'll see a little similar bar than you did in 22 and 23 with that compression.
Thanks, Cody. This is your investment slide. I apologize. This one was I can't even read this. Your book value plus accrued 25,568. Was it right? Woohoo! My eye doctor will be so proud. I'm going to just briefly go over this because we do have Clearwater here and they're going to discuss our investments. So. Our dividend income, this was a report that the board had requested to a specific figure that they wanted to see each month. And I'm not sure why this says.
That's my doing. You should have August in there.
Oh, for the love, why did you do that to me?
She has August numbers in there. I pulled the wrong slide, so that's fine.
Oh, good. Okay, well, I'll tell you. August is $85,320,000. So as you can see, last month was $50,000. So we are up $34,886 this month. Thanks, Cody.
Yes.
Making sure I'm on my toes. This report is again directly off the Clearwater dashboard. We talked about this last month with regards to the total return net fees, the income return net fees, and price return net fees. Again, Clearwater has an amazing dashboard, and there's more information on there than we probably would ever need. And this report was taken as of 9/18 when we created the board packet, so it's not ran through August 31st. This report, again, is with regards to the maturity of the investments. And it shows you where those are between the quarter, the half year, 3 quarters, a year, 1 to 2, 3 to 4 years out, and what those dollar figures are. I think it's important for the board to see this as we're talking about taking on new projects and where our investments are at and how far out they are, so we have some room to move those around. This slide is your cash, and right now it's $27,709,000. This is up $184,000 from last month. Our restricted funds, we keep the same. Stabilization funds, the board had recommended the $6 million. That has stayed the same. So everything is the same with the exception of our cash position. That's it. Any questions?
Thank you, Stephanie. Any comments or questions? Tim,
Not from my end, thank you.
Kristen? Okay, let's move on to Clearwater Advisors, Brandon and Dan. Bates. As opposed to Doug.
Correct.
Yes.
I think we should move to approve the monthly report. We historically do. I don't think legally we have to, but I think for just cadence of doing the normal business, maybe we should approve the monthly report.
Move to approve. Second.
Moved and seconded, all those in favor say aye.
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 I sent the slides over. Right, you copied the original, so I assume. You don't have them? Okay, I need to, hold on, I'll pull them up here, just give me just 2 seconds, I'll pull them up and I'll advance. He can use that advancer, so it'll actually work here. Just a second, real quick.
While we're waiting to do this, I think that we spend as a board too much time on this. I think you come quarterly. Is that our deal?
We meet with them regularly, but we were here last a year ago.
I'm sorry?
We were here last a year ago.
It's been
A year.
Oh, okay. So, I think we can get what we need to know. And I guess I would prefer quarterly rather than have our staff make a presentation about it because, managing cash is a very complicated process.
Are they just in PDF?
And-
Up there? Yeah, okay. I want to go into presentation.
We selected Clearwater not only because you're one of the leaders in the country, but you're friends and neighbors. So I'm thinking, looking forward to a more frequent visit from you and less with our staff every month.
Happy to do that as we move forward. As I shared with you, Cody and I mean, when I came on, these presentations were already set in motion and we didn't want to disrupt the year too awfully much. And so what we'll do moving forward with the new fiscal year is meet with each of the board members to find out what it is that they're wanting reported on a monthly basis. And then we can definitely have Clearwater come in a little more often. Or even I could just report on a quarterly,
Yeah,
so.
You okay with that, Chase?
Yeah.
Yeah, I mean, we'll do whatever you want, but,
Yeah. More than happy.
the
The less I have to
board's
speak. the
role
more.
normally is to select the best and brightest advisor, let them do their job, report basically the bottom line, and move on.
They're really good at it and they've been very helpful in getting me up to speed and showing me the ropes. So, yeah, I agree.
You test the advancer to make sure you can. It's not working. Yeah, I might need to advance for him.
We'll be back.
This one?
Oh, okay.
Okay, we're up and running. Directors of the board, Madam Chair, Vice Chair. Appreciate the opportunity to come here and talk to you about the portfolio and give an update. Last we were here was a year ago. We'll be more frequent. And I think the way that I'm going to structure this is go over what's been happening in the market since the last time that we met, and kind of more specifically what we've been seeing from the Fed. A lot of stuff going on there, so that's probably the most interesting thing to everybody. And then we'll go over the portfolio briefly and leave some time for questions. So going to the market review, since we last met, it was in October of 23, yields have fallen pretty dramatically. And this chart shows the degree to which yields have fallen. And it just so happens that in October of 23, yields were at the peak. And at that time, we didn't know that they were going to be the peak. And it's been kind of a bumpy ride from there. But overall, we've gotten 150 basis points and 100 basis points of decline in yields in the 2 and 30 year since that time. And a lot of that has to do with what the market's pricing the Fed to do, what they expect the Fed to do in terms of cuts and the direction that they're going there and what they're seeing in the economy reacting to the market, the slowdown in the economy that we've been seeing. And I try to emphasize that word slowdown because it's not, the bottom's not falling out, at least yet. And from a probability perspective, it's not necessarily our base case. But now we're kind of looking at the situation where we still have an inverted curve on the front end out to the 2 year. And then we have the longer end going steeper. And so we're seeing the re-steepening of the yield curve And that's important for what it means typically for the economy and how we position portfolios. But that's an important notion. Before we get to our expectations, I mentioned that it wasn't a very smooth path to where we are today. And so this just shows what the market has been pricing in for its expectations of the Fed's level of interest rates as of the end of this year. And so that this chart goes back to June of 23, and you see quite a bit of volatility there. It's gone up and down. If we can think back to what happened in October, November, and December of last year, yields fell very dramatically into that year end as the market was expecting the Fed to cut. They were expecting more cooling in the economy than we ended up getting. And then you see it reverse course at the beginning of this year. In that first quarter, yields moved back higher pretty dramatically as well. And that had to do with stronger economic data that we were seeing, stronger growth, less loosening of the labor market than was expected, and inflation kind of getting stuck. And that was the key there was a little bit of reacceleration of inflation in that quarter, which we've seen come off since then. And that gave confidence to the Fed to start cutting to the extent that they did. And the market started to price in more cuts. And so you see it move back down into the end of the year. And so quite a bit of volatility, pretty difficult to position portfolios in that type of an environment. But now that kind of takes us to what is the market pricing in today in terms of what they're expecting the Fed to do. So this chart, it's really just the bottom axis is dates of Fed meetings. And then the right axis is the number of 25 basis point cuts priced in. So the way to read this is in the middle of 2026, the market's expecting 8 25 basis point cuts by that time period from today. And so that also incorporates what we already saw, which was the 50 basis point cut. So it's 250 basis points of cuts from the peak Fed funds rate from where we were to the middle of 2022. And so how to put that into historical context is that is pretty recessionary. It's not the most recessionary, and we'll see a chart here in a second of kind of the Fed's path of cutting in prior cycles relative to today. But it is recessionary. And so that's quite a bit of cutting, 250 basis points of cuts. Their next meeting's November 4th. The 50 basis point cut that we just saw, it's kind of surprising. And I only say kind of because the market was basically locked in on a 25 basis point cut up until the Friday before, when some very informed reports in the Wall Street Journal pointed to a 50 basis point cut, and then the market shifted to price that in. So started to move closer to that 50 basis points. The market's almost never right in its pricing until just before the cuts or hikes happen. And so, that's why you see that variability in pricing. But really it's not the 50 or 25 at the September or November meeting that's most interesting to me. It's really where the Fed's ultimately going to get to. And the reason for that is we don't really know what's going to happen with the economy today. Right now, data's looking pretty good. It's not, things have cooled off. But as I mentioned, the bottom's not falling out. Employment is softening, and I have an employment slide here that I'll point to because that's really what the Fed's focused on at this point. They have a lot of confidence that inflation's on its path to their 2% target. But from a labor perspective, from growth, the consumer, those things have softened, but they're really not that bad. And so there's two different worlds that we could be living in. And the reason I say I'd be cautious on adding duration further than where we already have at this point is that when we have 250 basis points of cuts priced in over 2 years, you need more cuts than that to really benefit when you take a 2-year position. And so you need to see more yield decline and more cuts from the Fed than would be expected. And from here, that typically would be a more severe recession than what some people are expecting. So this is just a look at easing cycles in different periods of time versus what today is pricing. So it looks pretty good relative to what these other periods are. But I say that cautiously because if you look at the dates, it doesn't spell very positive outcomes. If you think of 2007, 2001, 1984, you get savings and loan crisis. One of those is COVID, great financial crisis, the tech bubble burst. So really, this is a story of when people say the Fed cuts and they cut fast and you take the elevator down after taking the escalator up, it's really because something breaks in the economy. And we haven't seen that. There's not anything on the horizon that looks like it's going to break, never does. But that pricing curve, the darker blue line, that could quickly become one of those. So there's a lot of downside risks to yields, which would be positive for a longer duration portfolio. So right now we're kind of priced for somewhat of a soft landing, mild recession, I would say. And then kind of the upside risk to yields from here is if we get an economy that nothing breaks and inflation maybe is stickier than we'd expect and growth continues at some reasonable pace, but we're not knocking out of the park. Then at that point, the Fed wouldn't ultimately get to as many cuts as they're expecting to. And then yields would have to adjust higher from here. So you have kind of two worlds that you're living in there, and we have to see what the data comes out as, and then how that develops over time in order to be more convicted in a longer or shorter duration strategy. But
just to jump in there too, it's interesting to know that the market has really shrugged off some pretty significant events. Events that we would have expected would have triggered some contagion. So the global bank or the regional banking crisis, the Ukraine situation, right now the Middle East. I mean, we have the precursor or maybe even a war going on right now, and the market has generally just ignored it, which is very interesting, especially given the caution. You know, there's a lot of people talking about, you know, are we in a recession? Are we heading into a recession? Is there going to be something that breaks? So then to have these major events where the market just shrugs it off is a very fascinating situation and something that we're monitoring almost, you know, every day, all day long.
Could that have anything to do with us spending like we're already in wartime?
I mean, everything's linked to spending, and I mean, that's a key point, that if you were to take away the short term, I mean, cash is inherently short term, so you have to think about tomorrow, next week, next month. But if you were to strip away the short term perspective, I mean, really that dominates the discussion, period. That's everything. And long term, it gets hard to talk about anything else.
And luckily, this portfolio only goes out to 5 years maturity. And so really all the risk related to the deficits and treasury issuance, it's largely further out the curve. And we've been seeing that play out recently. And if you look at even just, you know, forget political discussion and whether you get Harris or Trump, you're looking based on Penn Wharton's models at $1.5 trillion to $8 trillion of additional deficit over a 10-year period. And so, and largely that's tax policy. And so on, you know, Democratic policy, it's child tax credit. And on the Republican side, it's extensions of the Tax Cuts and Jobs Act. And we could get a scenario where you kind of end up in the middle somewhere where Congress is kind of gridlocked, where you have Republicans controlling one side, Democrats controlling another, and then you have to do a lot more negotiating and it tames things. So from a markets perspective, that's probably the best outcome from that, from a political perspective and impact on the yield curve. So I mentioned that the Fed's really just focused on employment at this point. The reason we know that is because at Jackson Hole and in the most recent Fed meeting, Chairman Powell pivoted to employment and basically gave indications that they think inflation's largely under control. At the most recent meeting, he said that they're not willing to tolerate any more slack in the labor market. And you think about that because when we think about what's being reported on a monthly basis for jobs, it's really not that bad. It's cooled off significantly from post-COVID. The last print was right around 150,000. The previous was right around 100,000. So it's cooled down quite a bit. The replacement level, Chris Waller, one of the Fed governors, he estimated the replacement level for jobs to be 80 to 100,000 a month. And so when you fall to below that, that's when you start seeing more cooling in labor. And of course, when we look at recessionary periods, it's usually marked by layoffs. And so you would see a decline in that number. We haven't really seen layoffs. And so we have seen an increase in the unemployment rate. That's the darker white line on the bottom of the left-hand chart. So it has been drifting up, but on a historical basis, it's still pretty controlled, just right around 4.3%, I think. But where you've seen most of the cooling is the number of jobs available in the marketplace. And so that's the top line, the darker blue line. And you see that it breached that just post-COVID peak and then has cooled off pretty significantly from there, right around 7 million or so. And so the next thing you would kind of look at is the layoffs, and you'd also look at hire rates. Hiring rates are below their average. So people aren't really hiring significantly, but they're also not laying people off. And so we haven't really seen that. And so you think, where is this increase in the unemployment rate coming from? And it really has to do with labor market entrance. And that's the right-hand chart. This is a decomposition of the change in the unemployment since it started increasing. And so you see that blue box there, that's labor force re-entrance and new entrance. And if you think about what's kind of driving that, one, we have prime working age is rebounding from pre-COVID. I know women of working age are also reaching record levels. And then you also have an immigration component, which since the beginning of 2021, there's been 9.3 million people entered the country through immigration. And so that has been a pretty notable impact on the labor force. When you think about the immigration side, that you have double the unemployment rate of Native American born. And so that's one thing. I mean, that has a lot of things kind of loaded into that, but from just a higher level of employment perspective, things aren't, again, this is another area where things aren't falling out, but it's cooling off. And, you know, one forward-looking component that you would look to that might lead you to believe there are going to be layoffs in the future would be corporate earnings and profit margins. Profit margins on the S&P 500 are reaching record levels, and corporate earnings have improved over the last year, the looking earnings for S&P 500. So really on the horizon there, why would companies lay off if they're doing relatively fine? I know we hear a lot about the tech industry and layoffs, but that's a pretty small component of the overall employment force. So any questions on the economy, markets before we move on to portfolio?
Thank you.
So now the portfolio, I also am victim to microscopic numbers. I apologize. Luckily, I put some of them, the most important, on the side that are larger. But here, just kind of want to focus on, you kind of already saw the maturity spectrum there. I'll blow these up next time. But really, we have a cluster in that 1 to 2 year. We have some things out on the, a little bit further out to 5 years. We have been building on to the end of the ladder. One of the reasons that we've been doing that is after the aquatics center was finished, we had a lot of liquidity and we were trying to extend to get back to the strategy and benchmark. And so we had to add duration on that longer end to build back up to that. And since then, we've kind of been, up and down on the benchmark because we have about every quarter we have a maturity that is reinvested. And so looking forward, probably kind of focus in that 1 to 3 year space, which is where most of the benchmark is, and also aligns with the plans of the district. And so, that's one thing, but those are also going to roll down over time. And so when we say that we're 1.7 years duration, by the next maturity, we're going to be even with the benchmark. And so you're going to constantly kind of have a little bit of duration in excess of the benchmark. From a yield perspective, we're even to the benchmark right now, and that's because we're a little bit longer. And when you're inverted, we're also at that lowest part of the yield curve right now. So we're kind of focused in that 1 to 2 year range, and that's that lowest end. So when you kind of get that concentration, you end up being a little bit lower. But we try to make up for that by adding agency securities. Similar risk to treasuries, obviously not a direct obligation of the U.S., but explicit backing of the U.S. And they usually come with about 5 to 10 basis points of pickup over the benchmark. And we try to maintain kind of a 60, 40, 70, 30 split there. But we definitely won't add if they're not advantageous enough. And so like right now you see in that 1 to 2 year space, agencies are like flat to 2 basis points over treasuries. In that instance, you really wouldn't add them. You'd add them at 5 and 10 over. And when you're looking, and also the book yield, so income generation of the portfolio, we've moved up in book yield over time. We've been benefiting from higher for longer. And so from the last time we met, we've moved up from 350 to 407 on book yield. And what that ends up looking like in income for the portfolio is about $1 million a year. And so you see for income, we've generated 780,000 year to date within the portfolio. And I'll talk about unrealized gains in a minute. I'm just happy to see a positive number because we spent a lot of 2023 in the negative in the fixed income world, a lot of red numbers. So I'm happy to be out of the Fed's hiking cycle.
And that's something too, I mean, we've done a lot of analysis on this and it's just generally accepted. Duration wins over time. There can be some short-term blips where, maybe rates increase and you will see some unrealized losses. Now, again, they're not realized, so they go away. But over time, history has proven time and time again that duration wins. And so the key thing here is to just keep that in mind. And as long as liquidity is sufficient, everything's great. And so that's kind of the key concept there is sufficient liquidity allows us to hold to maturity and continually to reap the benefits of duration. You've done a great job of that so far.
So this is a holding summary, and really, instead of looking at the individual holdings, because it's treasuries and agencies, kind of want to focus on sources of liquidity, because at the end of the day, our primary function is to meet the needs of the district. And when you look at the investment objectives of the portfolio, it's capital preservation and it's meeting your cash needs, and then returns at the bottom. And that is important, but returns at the bottom. And so when we think about sources of liquidity for the portfolio, and let's say, I know we've been talking to Cody and Stephanie about plans for future projects. And even if there's not something in 6 months, if it's a year or two down the road, where do we generate that liquidity from? And these are the primary sources. And so income, we already talked about. Portfolio at today's book yield generating around $1 million. For the maturities, I mentioned we have maturities about every quarter. We have 3.5 million maturing over the next quarter, and then another 1.5 to 2.5 million over each of the next 3 quarters. And so there's a constant stream of maturities that you can tap if you decide that you need to. And then if you need more on top of that, then we have that 250,000 in unrealized gains that we can go tap the market for. So a lot of that is on the longer end of the portfolio that we bought in October, November, December. But all of those together can help meet the liquidity needs of the district if and when you need them. And as I mentioned, any maturities that we have are probably going to be in that 1 to 3 year space, just naturally where the benchmark strategy are. And we've kind of extended duration to the point that it makes sense. And then there's obviously your bonding capacity that puts a big question mark of how much you're going to need from the portfolio in the first place. So, but we're ready and prepared to meet liquidity needs when you need it. And then performance. And one thing I'm going to highlight here is that since inception number in the underperformance, and this kind of goes to what Dan said of duration generally wins over time, and it's helpful because when you look at that since inception number at 15 basis points underperformance relative to the benchmark, one component of that was we were meeting liquidity needs. We were just coming out of meeting liquidity needs for the aquatic center until we were shifting our strategy. But then we had the fun of March of 2023 with the regional banking crisis, and yields fell pretty dramatically. And it just so happened because of the liquidity that we had for the aquatic center and starting to shift out, that we were very underweight duration at that time relative to the benchmark. And so you get 1 month of 29 basis points of underperformance, when if you strip that out, you'd have 15 basis points of outperformance. And so that 1 month with duration positioning and meeting those liquidity needs for the aquatic center, it made a difference from that perspective. But we're back on track, and you see that on a year-to-date perspective, just flat to the benchmark. And then quarterly, we're up 3 basis points. And when you look month to date, 2 basis points under, and we're overweight duration, you might think, whoa, the Fed cut rates. How does that happen? Well, it's because even though the Fed cut rates, yields kind of drifted higher since that time. And so, since they did that, so you never know what you're gonna get with the market, and we don't know where rates are gonna go. Nobody else does. The Fed doesn't know. And that's why laddering that the way that we do and maintaining liquidity and focusing on the cash needs and, liquidity for future projects is our primary component. And then after that, we try to manage that duration positioning as best we can, and then also pick up securities that give us a little bit pickup to treasuries, so.
That's something to keep in mind as well is, when you're in these pooled investment vehicles, these funds, oftentimes needed liquidity is not unique to one party. So when people need cash, case in point, when SVB blew up and there was that, the regional banking turmoil, everybody wanted cash at the same time. And in those situations, you can take pretty significant haircuts. So a week can have a massive impact. And that is one of the often overlooked benefits of a structured portfolio, in that you own the securities directly. You are not subsidizing anybody else's liquidity, and they are not subsidizing yours. So as long as it's structured properly, you will have the liquidity that you need for your projects or whatever your other needs are, and you're not victim to the market.
And I'll just make one more point on the performance, and you've kind of brought up the decomposition between the income and price return. And when I talk about the book yield of 4.07% that we've built from 350 a year ago, that's going to benefit the portfolio's performance and kind of buffer it from small deviations in price from today's standpoint, because the thing that's not reflected fully in that month to date is all of the income generation that you're going to get at that 4% annualized level. So that's going to buffer against those small price fluctuations over time.
Thank you. Comments or questions for Brandon or Dan? Kristen? Tim? Okay. What I see going forward is quarterly you come in and you do an abbreviated presentation of what you've just done. Basically, you do the last 2 pages.
Yep.
And that allows us to update on what's going on and ask whatever questions we need to.
Yeah.
And I would invite the board, in addition to you two, is Holbert still on the team?
Yeah, and we should have mentioned that he was planning on attending. He's not feeling well today, so he normally would be here as well.
But make sure we have the contact information for the three of you.
100%.
I'd encourage the board, if you read something that gives you a heartburn, call any of them.
We love that. I mean, it's no inconvenience whatsoever. We value this relationship. We value all our relationships. And the more we engage with our clients, the better. We learn from you. I mean, just observing your presentation on, hotel occupancy, ADRs, and economic, insights, that's helpful to us. So everybody wins. We welcome any engagement.
Thank you. See you in 3 months. Could you give me a motion on the,
Yes. Chair, pursuant to Idaho Code Section 74206(1)B, consider records that are exempt from disclosure under Chapter 1, Title 74. I move that we go into executive session. We do so by roll call vote.
thank you.
Ms. Mucko,
Yes.
Mr. Olson,
Here, yes.
Mr. Walker,
Yes.
Mr. Erkins,
Yes.
Mr. Restigar.
Yes.
We're in executive session. Thank you. goes to work on the details of the budget, which we'll have in a month. And we'll have another meeting of the committee. My takeaways are the first cut of the budget has margins, net bottom line margins in the 6% range. This year's 15%. In the past, it's been 20%. So as Cody likes to say, they're sharpening their pencils. So we expect at the next committee meeting, we'll have numbers that will be more like you're accustomed to seeing.
And that's kind of what we've historically presented in the first finance committee last year. I know it was in the 6% as well. My goal for this next finance committee meeting, we get it to the 12 to 15 from sharpening the pencil. That's just kind of going in and looking at where we have some overages, where we've outperformed in year over year or prior years. Just kind of a high level, and you guys will get this in my presentation next month, but we're forecasting a very similar year, 10.6 to 10.7. That's what we forecasted last year at this time. We're gonna hit close to 10.9, if not an 11 year. I think next year is, I'm going 10.6, 10.7, and I think at the highest we're gonna bring in is 10.8, 10.9 at the very highest. So that was where I met with the finance committee. How aggressive do we wanna be? In particular, we're down in conventions pretty significantly to the point of, you figure that number out, because we were at 72 and now I think it's about 14 conventions down. Yeah, 14 conventions down from year over year. So that's significant. But that it leaves us opportunity to actually drive more banquets and more meetings where we tend to make a little bit more food and beverage. So from a food and beverage revenue standpoint, this last year on that 10.6 million with all of those conventions in it, we had about 4.5 million in food and beverage revenue. I'm forecasting this next year, while I'm down significant in conventions, only 200,000 less in food and beverage. And that's because we're making more per event, doing some banquets, doing some meetings. And when we do that, we tend to not have to discount for food and beverage if they hit room nights. So the discounts are coming down and that's helping. And that's an area where I know I can sharpen the pencils. Our discounts, I think, were still a little high from what we were going to forecast this year with less conventions. So I can sharpen the pencil there. So I'm anticipating a very similar year with a little bit of a leveling off, or it may be a slight decrease, but very similar. And I think you can hit similar margins as well. And we're at 15 now, and I think we'll outperform that. Largest increases that we're seeing, insurance and benefits, wages continues to be a driving force to the budget. And then technical support, so computer stuff, things related to computers and technology are our biggest areas.
And again, to the board members, all of the staff is available, whatever questions you have and much detail you want.
So, Mr. Chair, Cody, I think we're gonna hit 11 million this year in our tax revenue, and you think that number's gonna?
It'll increase, that'll go up. So that one we're forecasting on the district side this year, we'll hit about, we've got forecasted about 11.1. I think that'll go up to 11.3, 11.4, could go up higher than that depending on if the ADRs continue to do what they're doing. But yes, they'll do really good over that. But what we are struggling with is those room blocks. But in some ways, if the higher ADRs on the district side, they're gonna win on the tax revenue side versus the convention side. And I think the locals will appreciate the calendar lighting up a little bit because we've had demand from locals. My only concern is we've kind of displaced through the conventions in 22 and 23, those increases, even into 24. So what we're doing is we're going back to kind of more of a sales technique, looking at events that would have happened prior to the pandemic that we've kind of pushed off the calendar due to the more conventions, and going back to them and saying, hey, we've got space available, and look to see if we can get some of those events back in our door again.
So do you add in other down years when we've had fewer conventions, have the transfers in the district to the center been higher?
Correct, yes.
Okay.
Yep. And that's that kind of what I pointed out, that December, those months that, again, operating a very large building like this, if we're not booked above 60%, we start subsidizing at that point. So that's where I tend to kind of really try to push the team on occupancies and making sure we've got events in the building, because that covers the fixed labor and all of our fixed costs. Just turning on the lights any given day is expensive in a big building, so.
Any further business to come before the board? Madam Chair, are you okay?
I'm good.
Meeting adjourned. Between Stephanie and Mike, look into Jim's question, which is, what are our limitations on investing in equities?
Okay.
It's Jim's recollection, and I vaguely too, that I know we can't do a Percy or an endowment fund kind of thing, but I thought they did allow some equity in our investments.
I thought it was a 90-10 split, is what the statute allowed for, but
I don't think so, but let's check, yes.
Albert.
Yeah, let's take a look.
I'm sure Dan will know.
Yeah, that, I don't recall anything in the statute about a split, but that doesn't mean anything. I could just be wrong, so.
I do remember something about that now that you're saying about Pat back in the day mentioning 90-10 on that. Yeah, we'll look into that.
and especially as our fixed income starts generating fewer and fewer returns, the equities can fill in some of that gap.
We're not really very liquid either for.
Still need, just as a reminder, board dates for next year's board meetings from you. I think I've got everybody else, so I sent that sheet. If you can, I have one if you want to fill it out blank, or you can give it back to me, however you want to do it too, so.
Mine come through.
You did, I got everybody's.
See you later.
Thanks, Jason.
You got everybody?
How's that chat?